I think the best book from a conceptual or, if you like, philosophical angle on these issues was a book written by Gary Stern and Ron Feldman. They actually wrote it in 2000, it appeared a little bit later, called Too Big to Fail. And Mr. Stern was head of the Minneapolis Federal Reserve Bank, and Mr. Feldman is a senior regulator. So they really know the US financial system very well. And they anticipated and predicted many of the problems that we've encountered. They understood the incentive problems, they understood the distortions. But what's fascinating about their book is that they didn't at all predict or understand that investment banking would become the center of the too big to fail problem. So if you look at their list of candidates to fail, some of whom, by the way, have not yet failed, but I'm sure this will come, it does not include Bear Stearns, Lehman Brothers, Goldman Sachs, Morgan Stanley, or Merrill Lynch. And as we go back and understand what happened over the past decade, any coherent story has to feature these 5 players. So if we apply that, let's apply that same limit to knowledge and limit to understanding, and let's say that we're at least as good as Stern and Feldman, and maybe we've learned something more since then. We should be very cautious about where we think the next too big to fail problem will come from. So people say to me often, it's not hedge funds. Simon, they say, hedge funds were not at all responsible for this crisis, and I would agree to that. But that tells me nothing at all about the future. The hedge funds could easily become big enough to be damaging. If I were running a hedge fund, I might even be tempted to do that because I would think it would give me some interesting options down the road. Insurance companies. I think we should be talking much more about insurance. AIG, after all, was ostensibly, and in fact, a form of insurance company, even in the parts that failed. But maybe we should also talk about other companies. Maybe we should be talking about non-financial companies. Some non-financial companies, for example, are quite eager and even active now in the over-the-counter derivatives market, which after all isn't a largely unregulated market. So I think, what I would insist on is that we have learned finance can become dangerous, and we have learned that the nature of finance and financial transactions is such that they suck a lot of people in and then they blow up with enormous damage. So I think that this part we know. But I think we should be very cautious and not insist that it must be the same banks again. Now, I think there are some obvious candidates that should be taken on in the US, right? So I do push that point. But I'm not saying that our concerns should end with changes we propose in our book. I'm saying that these are necessary but not sufficient for financial stability. And we should, I think, guard very carefully against our own hubris in assuming that because we might see a little bit more clearly now as a result of the crisis, that we therefore understand where these kinds of risks will come from in the future. There is a very good saying in the semiconductor industry, which is attributed to Andy Grove of Intel, only the paranoid survive. I suggest we should apply that to financial policy also.